Welcome to Geojit Spotlight. The Sensex and Nifty are hitting all-time record highs, dominating the headlines. But if you look at your personal portfolio, you might be asking a frustrating question. Why haven't I benefited from this historic rally? Joining us today to share his expert's views on the current market scenario is Dr.V.K Vijayakumar, Chief Investment Strategist, Geojit. Welcome, sir.
Thank you, Abhilash.
So the market has set a new record high, but retail investors haven't benefited from this rally. Why retail investors couldn't participate in this rally? What was the problem with the retail investment strategy?
Now, this rally this time and the new record set by Nifty and Sensex are very, very unique in the sense retail investors did not participate in the rally, and therefore there was no celebration in the market. Normally, when the market touches a new high, there will be a celebration, fireworks, parties and all that. But this time it was very quiet. There was no celebration. The reason was retail investors did not participate in the rally. Now, even at the peak of this record high, it touched Nifty touched 26,325 on the 1st of December. Even at that point, the small cap index was down around 9%. And we know from experience that retail investors have portfolios dominated by small caps. That is the psychology of the retail investors. They don't like large caps because large caps are apparently the valuations are very high. Larsen & Toubro, 4,200. Like that they avoid. And they would prefer a share which is trading at around 16 rupees, 17 rupees, hoping that it will double in 1 year. But this is a wrong approach to stock selection. So retail investors could not participate because their portfolios did not participate. The value of their portfolios were lower at this record level than the value in September 2024 when we had the previous peak in the market. So this was the mistake which retail investors committed. Also, another very important point that has to be noted is even in the large caps, all the stocks did not participate in the rally. It was a narrow rally dominated by a few stocks. It is important to understand that 8 stocks in the Nifty, 8 stocks, HDFC Bank, Reliance Industries, ICICI Bank, Bharti, L&T, ITC, Infosys and SBI. These 8 stocks account for 50% of Nifty's weightage. The balance 42 stocks account for the other 50% of the weightage. So out of this 8 stocks which I just mentioned, if some 5 or 6 stocks do well, the market will go up. This was what happened. And it was assisted also by other stocks like BEL, Eicher Motors, Bajaj Finance, Indigo. And remember, these are the stocks which we had mentioned last year. All these stocks we had mentioned last year as safe large cap stocks to invest money. So from this lesson of retail investors not participating in the rally and therefore being unhappy about this new record, the important takeaway is they should change their investment strategy away from low-grade small caps to high-quality large caps and high-quality mid caps also.
So will this rally sustain or what will be the trend going forward?
A main concern now in the market is normally when the market sets a new record, that rally will continue for some time, but this time it did not happen. From the high of 26,325 at the Nifty level, Nifty corrected by more than 400 points, but that correction was mainly driven by the depreciation in Indian rupee. Rupee depreciated by more than 5%. This year it is one of the worst performing currencies in emerging markets, except Argentine peso and Turkish lira. So when currency depreciates, FIIs will lose. Therefore, anticipating further correction and also because of the high valuations in the market, they sold in the market and they took the money out. Also, the AI trade, that was a dominant theme of the stock markets globally. A lot of money moved into the artificial intelligence stocks, that also impacted our markets. And because of this reason, we had a correction, but there is fundamental support to the rally. Again, the market will rally. It will again go to a new record in the coming weeks and coming months and next year certainly, because there is fundamental support to the rally from very high GDP growth. This year, the GDP growth projection, FY26, is 7.3%. And the RBI governor who declared the policy today, 7.3% GDP growth, up from 6.5% at the start of the year. Inflation is under control. Corporate earnings are coming back. These are positive, and the market will certainly respond to that. Therefore, the market will rally. New records will be made. This 400-point correction from the peak can be seen only as a consolidation in the market.
So many market experts are talking about a possible crash in AI stocks. Is there a risk, and how serious is the risk?
There is a risk in the market. I'm talking about the global markets. Even the RBI governor in the monetary policy referred to the elevated valuations in global equity markets. I'm quoting his words. Elevated valuations in global equity markets. And many experts are talking about high valuations and a potential bubble building up in AI stocks, ultimately resulting in a crash in the AI stocks. But a very important point to understand is that there is not a bubble as of now. Valuations are high, but comparison to the 2000 tech bubble is completely wrong. In the 2000 tech bubble, when Nasdaq multiplied 5 times from 1995 to 2000, Nasdaq PE ratio touched an average of 1992. And for many internet stocks, which were loss-making, which was going up only on the basis of hope that they will be making money in future, there was no justification at all for the stock valuations. But the PE touched 100, 150, even 200 for many stocks. And that was why they crashed massively by 78% when that tech bubble burst. Now the valuations are not in that bubble territory. You take the top 6, what are referred to as the Mag 6 stocks. If you remove Tesla from the Magnificent 7 stocks, you have Mag 6 stocks. These are Apple, Amazon, Alphabet, then Nvidia, Meta, and Microsoft. If you take these 6 large stocks, mega stocks in AI, and also stocks like Samsung of South Korea and TSMC of Taiwan, valuations are not excessive. For Nvidia, the trailing PE ratio for the largest, most valuable company in the world, trailing PE ratio is only 44. For Microsoft, it is around 37. If you take Apple, Amazon, and Alphabet, it is in the range of 30, 33. Many Indian stocks are quoting at 50, 60, 70, 100. Even IPOs coming at ridiculous valuations of more than 200. So my opinion is that valuations are high. There has been a huge run-up. And therefore, when there is a huge run-up with new records being set, several records being set, there can be profit booking, and that can cause correction in the market. But I go with the opinion that there will be correction in AI stocks, but a crash is a remote possibility, not a high probability even.
So what should be the right investment strategy in the present context?
Well, even now in India, valuations are not cheap. If you go by India's 10-year PE ratio, 10-year PE ratio is about 18.5. Now Nifty is trading at a trailing PE of 22, the forward PE of more than 20. Therefore, we cannot say the valuations are cheap, but the valuations are fair compared to the valuations in, let us say, September 2024. But mid and small caps are even now valued higher than the valuations of large caps. Mid caps have a PE ratio. I'm talking about NSE mid cap. PE ratio is around 33, but mid caps have strong earning support. Small cap, the PE ratio is 29, excessive, particularly when you consider the fact that there is no earnings growth in small caps. So even now, with the new record high in Nifty and the Sensex, investors should be focusing more on large caps with growth potential and mid caps also with growth potential. Growth is important. There is growth in banking and financials, and valuations are also fair. There is growth in cement. There is growth in some segments of capital goods in which companies like Larsen and Toubro are operating. There is growth in telecom. That's why the telecom majors are doing well. Bharti Airtel is doing well. There will be earnings growth, and Reliance will be coming with the Reliance Jio IPO in the next year. So all these are very significant factors. You should look at growth segments. Energy is another very significant segment. Defense, you can expect further growth. So focus on segments which are likely to report good growth, and focus on stocks which are not overvalued.
Thank you, sir. Thank you very much.
Thank you.